tax slabs was announced in the budget earlier in the month, there was definitely a sense of relief. More money in the hands of citizens could mean more spending that drives consumption. It could also mean more savings, but there was also a belief that it could mean more investment into the stock markets. Well, the latter is in fact also thought to be the reason behind lower deposits. Our next session is deposits and flows, the macro challenges, where our guests tackle this very nuanced topic. I'd like to invite our panelists on stage. Please put your hands together for Madan Sabnavis, Chief Economist, Bank of Baroda. A very warm welcome, sir. Also, we'd like to invite on stage Mridul Saggar, Professor and Head of the Center for Macroeconomics, Banking and Finance, IIM Kozhikode. And a warm welcome also to Madhavi Arora, Chief Economist, Emkay Global. And once again, I'd like to invite Siddharth to lead this session.
Thank you very much and a very warm welcome to our panel, Madhavi Arora, Mridul Saggar and Madan Sabnavis. So what we want to do in this session, and as many of you know, those who are watching us right now and here in the audience, that this is a banking and economy summit. I have economists here with me and the art and science of economics deals with both the macro and the micro, but the session that we have with us is deposits and flows, the macro challenges. So I'm going to go to Madan first to help him get all of us to understand the battle for deposits and the biggest challenge. And Madan, straight away diving into the question that perhaps might frame this issue: has the CRR outlived its utility from a banking and therefore consequently economic perspective as well?
So when we're looking at the CRR, we should remember what is the ethos behind the CRR. It is more a case of maintaining the integrity of the system. So today when we're talking of CRR, we should not be looking at it as a measure of providing liquidity to the system. Okay, so we did have a cut in the CRR, but I think interestingly the RBI governor had mentioned very clearly that it was to take the CRR back to what the original level was before we had the Ukraine war came through. So the CRR, I won't say has outlived its purpose, but I think it can be used in a more meaningful manner when it comes to the banking system, because there are other regulations which are in place, like say the LCR. Now that is the amount of liquid assets which banks are supposed to hold. Now if per force you have to keep 4% of your NDTL in the form of cash with the Reserve Bank of India, if you allow the same thing to be a part of LCR, I think that's one way in which you could free out reserves. But having a CRR intrinsically I think is required. Though I think I could also give the other argument, economists wear on two hats. I would say that since RBI never lets any bank fail, so even in case there's a crisis, I don't require the 4%. The RBI will make sure, we have examples to show that certain banks did not close down, however bad the situation was there, because I think as a central bank, as the regulator, the RBI ensures that things will go back to normal. So there are arguments on both sides, but I think since we are going to live with the CRR, if we can make it more effective in terms of adjusting it in the LCR, I think it would help the banking system a lot because it would provide liquidity in an indirect manner.
I'd asked this very same question to Mr. Dinesh Khara, who is also here with us. Madhavi, I'm coming to you. Madan has offered us two arguments on this. Do you want to supplement to them, and do you agree with the basic question that I had posed?
No, I agree with Madan to that extent. See, over the years, the macroprudential norms have also evolved. At this point in time, your LCR ratios are pretty much comfortable. In fact, most banks are running around 130 plus kind of an LCR. at this point in time, even if you're keeping a CRR which is say more than 4%, which is what they've historically kept, would have anyway led to more sucking of liquidity from the system. So I think to that extent, it was pretty much required that they release or normalize a CRR for that extent. But I agree with Madan on that front that ideally when you are, in the end, your macroprudential norm should be in a way that you're able to protect the, any kind of a bank run that you may face in terms of stress. At this point in time, I think given the way banking system has behaved over the past 7 to 8 years since 2013, the way they've worked in terms of keeping their balance sheets very healthy, they've largely deleveraged. I think very clean balance sheets of banks has basically meant that to some extent, even if we probably play around a little bit of CRR in terms of easing the CRR further, wouldn't necessarily be too bad a thing, because at this point in time the LCR norms are pretty much tight, pretty much comfortable, and to some extent there could be leeway on the other side to let banks breathe a little bit in terms of easing some liquidity from the CRR point of view. But again, it's a very tight prudential norm. I don't think central banks would be comfortable fiddling with it beyond a point.
Professor Saggar, now your perspective on this, and Madhavi made that point, letting banks breathe a little easy. Given what is happening overall in the macroeconomy, is this something as an idea whose time has come?
So let me clarify one or two things in this regard. I mean, I think the first misconception which I'm seeing here is that CRR is some sort of a financial stability tool. It was never intended to be a financial stability tool. It is a monetary policy tool. So basically CRR is to slow down the pace of credit creation if inflation is high, and that's the objective of the CRR. So monetary policy is conducted on two scores. Either you control directly through the reserve requirement, the bank reserves, or you alter the interest rates, and through the market interest rates you control the level of bank reserve creation. Either way, it is the stock of money creation which would cause inflation or sort of slow down the inflation if we slow down that pace. So CRR is very different from LCR. LCR is the financial stability tool. LCR is more closer to the SLR tool. So the SLR tool is basically aimed at government securities, but the government securities need not be the only high quality liquid assets. So you have the LCR where you have runoff factors depending upon the other securities and stuff. So I don't see any worry that the level of CRR would have its impact on the financial stability, but I have my worry if it is completely taken off as a tool, because it's good to have a Swiss knife kind of arrangement for various instruments should they require, and still you need not, you can lower the CRR, but you can use your interest rate tools to control what you intend to do from the monetary policy angle. So I am still a bit puzzled why we are debating this.
Okay, go ahead.
Actually, I have a different view from Mridul out here, because if you are saying that CRR is not meant for financial stability, but it's a monetary policy tool, then the question is why have we not used it very often? So the CRR has not been used that often. Why do you go in for an open market operations? So why do you want to sell government securities or buy government securities, straight away increase or decrease your CRR? So based on the revealed action of the Reserve Bank of India, my view is that CRR has been used more to ensure the integrity of the system rather than a monetary policy tool, based purely in terms of the frequency at which you have been using it. Because there are lots of countries, central banks who don't even have a CRR. So when they're talking of this basic question, lots of countries have it, lots of countries don't have it. And I'm sure those who don't have it, they also have very stable systems. So I don't think there's anything right or wrong. It's just a path which you're following. But the way I look at the CRR, it's more for the integrity of the system. But this said, as I mentioned earlier, the RBI will ensure anyway that no bank ever fails.
No, Madan, that's right, that CRR today is less important. It need not be important. I'm there with you on that. What I'm trying to say is that the very reason why this is there, because you are saying why do we do open market operations? Because it's market based, and that's what market-based operations achieve with less, and Mr. Dinesh Kara is here, he has earlier argued, his bank has argued for remunerating CRR. He, in my last conference at NSE, was arguing about the green deposits getting the benefit for the CRR. So I very much appreciate those kind of arguments. But
historically, they've never touched CRR unless
Yeah, go ahead.
in terms of stress, only in terms of stress or in terms of, pivot movements in India's economies. Otherwise, you would never see policymakers touching CRR. It's like a constant in our equations.
then it's constant now because we have indirect
Yeah.
tools of monetary policy control, which are market-based. And that's why CRR is direct.
Viewers, this is the closest that you can get in terms of a evening prime time slanging match that you see on general news, because these are very eminent economists who are debating this. I want to bring in Mr. Khara because we are fortunate to have him here as professional banker and also till recently the head of the State Bank of India. Mr. Khara, just add to this because this is a very fascinating debate.
No, I think when we look at the kind of preemptions which are happening in terms of CRR and also SLR, the only issue is when it comes to the cost of credit. So this is something which is also having its impact, particularly when we are trying to become a globally competitive economy. Then we'll have to probably strike a balance. What Mr. Saggar has also mentioned in terms of LCR being something which is more from a very different perspective and more in terms of nearer to the SLR. Can LCR be made part of the SLR? At least, if at all that can happen, the extra preemption can be stopped from the banking system. And at least as far as the cost of credit is concerned, that is one of the major aspects when it comes to the manufacturing aspect of the economy and also the exports of the economy are concerned. Do we have the luxury of having a LCR and also then adding on to the cost of credit? That's the worrying part.
Absolutely, and that is the reason why probably Reserve Bank brought down the SLR over a period of time to align with the LCR regime. I would, over a period of time, would say that SLR needs to be phased out, and we need to stay with LCR. But then we have to have more fiscal discipline, because SLR is a tool to direct the credit to the government, and that sort of is actually crowding out private credit. So over a period of time, that should be the steps in that direction, and we should not have the burden really of both SLR and LCR. That's sort of a financial repression regime of the past, from where the vestiges still remain.
See, actually out here again, Mridul, I have a different view. When you're saying that SLR is a tool to make sure that to ensure that government borrowing takes place. But actually, if we're looking in terms of all the crises which we have had, at least recently in the US, it was basically a case of liquidity. So I think more as a liquidity, I think this is the way in which we have interpreted it, that the SLR is meant so that the government borrowing program is enabled. Yes, government borrowing, there are market borrowings which are taking place. In fact, I remember when I was a student, there used to be this automatic monetization of the deficit where RBI would print at 4.6% treasury bill. We have done away with it, and we're making sure that you borrow from the market. Now, when you're borrowing from the market, you need government paper. So, I think the very fact that even before the LCR concept came, we saw that banks were holding on to excess SLR. That itself means that given the kind of asset balance or asset creation which banks are doing, they have found value in terms of holding on to government paper. It's not to say that if there was no SLR, all the money would have been lent to the commercial sector. I don't think such a thing would have taken place. So I wouldn't like to relate SLR to enabling the government borrowing program, though it does happen, because if the government stops borrowing, then you will not be having this additional paper to...
Certainly not. That is what I meant, that you shouldn't invest in government securities. I'm only saying the market principle should dictate that investment. The cost of government debt has to be market related. This is a reform we did way back in 1990s. So we have to go that route, and LCR does perfectly allows government securities to be recognized as HQLA 1A. So what is the problem in dispensing and moving to a regime which recognizes government securities?
But that
And
did lead to lazy banking is what you guys also sort of argue, right?
so once we have a market-based regime, the lazy banking would be even less.
Yeah.
See, that's what is important. But the choice will be with the banker on what should the portfolio he should hold. And if government has fiscal discipline, probably you will get low-cost government borrowing. And that's what we need.
You know, at most Business Today events, and many of you would agree with me, we have a concept of master classes. So there are certain sessions which are called the BT master class. This session wasn't called the BT master class, but one is panning out. So I'm really happy. Now, why did we get into this? Just for those who may not sort of follow all the intricacies of the subject that was being debated here, there is a structural challenge, and this topic I had taken with Mr. Khara in the opening session, which is what is happening to deposits. And for a banking system where for every 100 rupees, Mr. Khara, roughly 4.5 rupees are locked up, not earning any interest, this question assumes a lot of importance. Madan, let's now come to the broader issue. There's a debate as far as our macroeconomy is concerned that have we seen a structural slowdown or a cyclical slowdown? But on the issue of banking deposits, is this a permanent or near permanent change in behavior and a structural shift away from fixed deposits towards an era where the younger generation, first time wage earners, those who have a little surplus, are now moving into higher return, higher risk investment opportunities?
Okay, it's first on the lighter side, I think, Siddharth, when you said whether the slowdown is cyclical, temporary, but don't we always say that we are the fastest growing economy in the world? Even at 6.2, we're saying it. So isn't there a contradiction? That is the economy really slowing down, or are we the fastest growing, galloping economy in the world? Anyway, that's on the lighter side.
It's not a one-eyed person in a room full of those who cannot see argument.
No, I have two eyes anyway right now. Okay, now the important thing is that yes, we have seen that there has been a kind of shift which is happening when it comes to households, because we have a situation where income is not growing. Income is not growing, we have high inflation, so consumption has gotten affected. We have seen that financial savings have also been affected. Household debt has gone up, people are borrowing funds from the banks. In this kind of a situation, as far as financial savings are concerned, they're coming under pressure. If you look at the way in which deposits are looked at, whatever interest are earned, that part is being taxed. So how many other representations were made saying that make it comparable to what happens in the equity market, you don't get any say there, and it doesn't look like that there are going to be any benefits. So logically, if I have some bit of risk-taking ability, it makes sense for me to go into the mutual funds. If I'm even bolder, I probably invest directly in equity. Now, there has been a counter-argument made saying that finally all money has to reside with some banking account. It goes from my account to an AMC account, so it has to be in the banking system. But of course, there are leads and lags. And as we are in the banks, we know very well that there has been a shortfall in terms of deposits, and that's why we have this liquidity issue which has come up. But I think going forward, I think this is going to be a continuous challenge for banks, especially today when we are saying that interest rates have already peaked at repo at 6.5%. And now there's a lot of pressure to bring it down, which means that deposit rates are not really going to increase. So banks are going to face this challenge going ahead as to how do you garner deposits, especially when individuals, households are becoming a bit more conscious of what's happening around. They're looking at alternatives and they're able to get probably better returns.
Madhavi, on the same question to you.
I think the biggest reason as to why you haven't seen deposit growth happening over the last 2 or 3 years has largely been because the reserve money actually has grown on an average CAGR basis around sub 4.5–5%. RBI's balance sheet itself to start off with, which is where the money starts, right? In the end, the money is printed from the central bank's book. That is growing on a CAGR basis of around 4–5% from the peak of COVID. Clearly has replicated in the form of reserve money, which has also been sub 5%. Automatically, your money M3, right, offtake itself, which is basically right offtake and other factors, has also been sub 7–8%. So I think it's emanating from the fact that the policymakers themselves have been very a constraint, or they didn't want to necessarily overheat the economy. It was a conscious policy decision to some extent, and to some extent it's also a function of how the foreign flows have been behaving. So RBI's balance sheet on net has not grown. If the money is not been printed by the central bank, it would not percolate into a money multiplier process in the first place. So that's the structural problem, and it hasn't changed. If in fact this year RBI's balance sheet so far is actually 0.2% growth YTD. So clearly there is no new money creation that has happened, partly because RBI has been intervening over the last 4 months specifically to save the currency, owing to factors that we all know of, one of those being massive FPI outflows, which has obviously meant that there is no new money that has been created. Whatever liquidity infusion RBI has been doing in the last 1.5 months has essentially been sort of paying for its own past sins of the last quarter of December, when they had intervened to the tune of nearly $100 billion, when the structural or the fundamental requirement of the economy was not more than 25 billion if I look at the balance of payment deficit for that quarter. So generally the central bank will intervene to the extent of the BOP deficit.
Right.
On an average, in a normal scenario, we went way too far.
Right.
Our forward book is so heavy that RBI will have to come back to the spot market or in the liquidity market, in the banking system liquidity, to sort of pay off its forward book. So there's a problem in the liquidity in the system as of now. Whatever RBI is doing is just trying to ensure it smoothens, but it's still pretty much close to around 1.5 to 2 lakh crore deficit on an average,
Right.
and that could probably be the case by the end of the year as well,
Okay.
despite RBI doing whatever. So I think the structural problem is that the balance sheets of central bank has not grown. The money has not been printed on net.
Professor Saggar, come in on this point before we move into.
Okay, so for once I'm agreeing with my co-panelists here. So actually the reserve money growth is low. At 4.1% year on year, the latest number, it does look still very low. So it's not that the RBI recently has not done enough. It has taken a lot of measures to ease the liquidity situation, but the system is still in deficit. And given that the growth has tumbled in Q2 to 5.4%, there is reason to calibrate the liquidity, to my mind, in a moderate surplus zone, not go overboard the way pandemic time was done, neither squeeze liquidity, because that's going to affect
In your
the
view,
real
Professor,
economy.
is it because a certain set of decisions was taken and the MPC also has a way of working, or was it an oversight? Madhavi had some words for the RBI. What is your view on this?
So the MPC, as per the RBI thing, is that they set the interest rates, the policy rates. The liquidity is directly with the RBI and is more daily operations. So as Financial Market Committee, one has to see that liquidity is enough in line with the monetary policy objectives. If it needs to be squeezed, it has to be squeezed, but current situation doesn't demand that. And
What does the current situation demand? Because, let me once again remind, Banking and Economy Summit, and let's try and look ahead, Professor, and I'll start with that question, tossing it to you again. What does the current situation require to ensure growth comes back? We know the tax cut, there is a debate on how effective it will be. Where do you stand on that?
so I think both fiscal and monetary policies have responded of late. We should appreciate that. The budget had a very tough time to balance a lot of considerations, the debt sustainability, slowdown, everything. So they got broadly the mathematics right, except probably a little more capital formation would have been good for if capex would have been increased and not left entirely for the states to do that. Maybe the capex multiplier is much higher than that of revenue, and the economy would have benefited a wee bit more out of that. But
Dinesh,
this is a small
Dinesh Khara's
point.
point of view as a professional banker on that very point was that we should give adequate importance to the 50-year loan that's been given to states, because a lot of capacity creation will happen. I'm just adding this to the point.
I agree. I respect that view also. What I'm saying is that you have to find more. See, let me also clarify one more point. states do more capex than the center in aggregate. So that matters. He's absolutely right when he said this. What I'm trying to say is that there has to be some more fiscal reforms to rejig, create a space out of the revenue segment by pushing resources into the capital account.
Okay.
If we do that, we will be much better off. But it requires some political gumption. I mean, every time you tread on something, we have to appreciate that people have to be educated to understand what's happening. I mean, for instance, here when you talk about credit growth and regulation, it's fine. You want growth. Everybody wants growth, but we don't want growth at the cost of financial stability. So it's not a good idea to keep postponing all the financial stability measures just because there is some growth sacrifice. We have to trade off in a very sensible way over what are the costs of regulation, what are the costs of macro.
You wanted to intervene, Madhavi?
So there is no overheating at this point in time. While I agree with you with regard to what you're saying, that you need to be a little careful about other financial parameters, but at this point in time, with the credit offtake that where it is, and when it was even at 15-16% a year ago, it's a very different cycle from what we saw in the past, right? In this so-called high LDRs that we were seeing in the last 1 year, were not coming out of a very overheated economy. In fact, everything else, as we all know, the banks are in pretty much healthier shape than what they were in the past. And there are no macro excesses whatsoever. There is no CAD, there is inflation which has been very well managed by the central bank. There is no money which has been new money which has been really pushing the economy for inflation to really percolate. So I think there are no macro excesses. In this cycle, if you still find reasons to constrain credit, you are just going to have a downward spiral in credit, which obviously will also flow into deposit in some form or the other, because there is no excesses in the macro imbalance at this point in time. While we can argue that they may turn up ugly, I'm not sure, but as of now, it's nothing like 2011, neither 2013 or even 16 for that matter. It's like we are basically becoming very pro-cyclical from both fiscal and monetary side.
You want to respond to that before Madan comes?
Every time we think this time is different. That's the basic problem.
Well, that is human nature.
And that's credit need not be constrained. I mean, we didn't constrain it after the global financial crisis, and then we had all kind of crises. So we can't really. What I'm trying to say is have some reasonable balance. See the cost of regulation, but also see the cost you will have if there is disruptions in the way where you have financial fragilities exploding.
Madan, come in on this.
Okay, so I think first when you're talking of growth, I think we need to remember that anything that's done on the fiscal side takes care of the demand situation. Anything that happens on monetary policy is a supply side response. So today when we say that the interest rate has been lowered, the question is that is growth in credit going to pick up? Okay, just all of you in the audience out here, just because interest rates have come down and let's say there's an EBLR, there's been transmission, are you all going to go running and buying houses? The answer is no.
Yeah, one large bank has announced a 25 basis points cut, and the press release was one of the longest that I've seen in the recent past. That just happened today.
No, but so the thing is that once you lower by 25 basis points, immediately in less than an hour's time, people are saying how many more rate cuts are going to be there? Will it be 50, 75, 100? All this kind of nonsense keeps going on as if it has to happen in the next policy. So anyway, keep that aside. So the basic question in India is that we have an issue on the demand side. Okay, people are not spending money, industry is not investing. It's easy to say that the private sector is not investing. But if you look at industries which have high capacity utilization rates, they're the ones who are investing. So you look at steel, there is investment taking place. You look at consumer goods, investment is not taking place because they have surplus capacity. So I don't think we're running into a situation of saying that there's going to be a paucity of funds because of the liquidity situation which is there. I think when there is an opportunity, people are going to spend. And as long as we are saying that the Indian economy still grow at 6.5%, 7%, that's much lower than our potential. I think we're in this kind of a comfortable equilibrium which is there. There's not going to be a problem even though deposit garnering is going to be a challenge. Credit growth is not going to be at an accelerated pace. It's going to be very, very gradual. So I think this 12% growth in deposits, 14% growth in credit is something which can still be managed in the economy. And I think what the RBI doing at one stage, one can say that is there too much of regulation? Are you trying to bring in these new capital norms which came for unsecured loans? You have the new LCR. You have the expected credit loss norms which are going to be implemented in course of time. I think prudential regulation is something which is very much required. Now, is it too stringent or not? I don't work on the business side of a bank, so I cannot answer
Madan,
that.
Madan,
But otherwise, when something goes wrong, people will say, why was the regulator sleeping?
Madan, the government has decided to look towards deregulation. Committee is in the works. Is there also, and the finance minister made a mention of that, what would you say about financial sector deregulation or relooking the current framework of regulation across the Indian financial sector?
No, I think deregulation is always a good thing, but you have to keep the integrity of the financial system in mind, because if anything goes wrong, it can actually spiral backwards and we can have a larger crisis. So I think deregulation as a principle is absolutely right. There should be less interference. It should be more of the market forces. But at the same time, since we're dealing with other people's money, I think there needs to be a lot of caution which is exercised.
Okay.
Therefore, we need the RBI.
Since it's the final minute and a half, I've just received some questions from the audience. I'll try and get you to quickly answer. I'll just take the question. Whoever wants to answer, please do. The first question is, the importance of technology in the banking sector. How significant is it? Just a quick comment from anyone on the panel. Quick.
No, I think it's very much important because we have seen technology has been used both on deposit sides, on credit side, as well in terms of operations. It has enhanced efficiency, but of course there have to be the necessary safeguards to make sure that there are no adverse repercussions which take place. Cyber security, those are issues there. But I think this is the way to go forward.
Okay, one fine. So
it's so important that it will decide the survival of the banking. So there's no other option. I mean, you have to adapt to the new technological changes. We are going to see a lot more tokenized deposits will come, for instance, and that will clearly change the speed and the whole dynamics of. We are sitting today no deposit growth. You would see phenomenal deposit growth if that is allowed.
That will be the best way for any kind of penetration that you're seeing in the system now. Because
okay, I will take moderator's privilege because there's just one quick point, 30 seconds each. Madhavi, I'll start with you. Considering the latest cooperative banking scam, and I hate using the word scam, but there's an issue we know. Is the role and relevance of cooperative banks now up for debate in India? Why are we still persisting with that institution? I'll pose the same question starting with you.
I'm not the best one to answer that. I don't think I'm well read on the corporate bank,
okay.
cooperative banking. Maybe
no, I think there's a lot of value which comes from the cooperative banking system, and it's something which has been there for decades together. I think the clue is that how do you regulate it better? Have your inspection regularly and try and catch it. There will always be problems. I think it may happen to another bank. After we had it a few years back also, we have a second bank. It could be happen, but I think we just need to tighten the regulation and surveillance.
Professor Saggar, the final word and ending the panel on that question, because when we talk very high level banking, it's ultimately the depositor and common people, small depositors in cooperative banks. In a system that is so well regulated, every few years you have these scandals emerging. So it's clearly a big question which needs a response.
We have to set the shop right, or otherwise fold the cooperative banks. There are problems with small finance bank, cooperative banks, whatever. Cooperative banks, the governance of the cooperative banks is the crux. I think till that is set right, nothing would work.
And a quick point, I think when you're talking of deposit insurance, which the government is planning to increase, it should be differentiated across banks. I think that will work well.
Okay, so clearly this could have gone on for another half an hour, but we have run out of time. I thank the panel here for that master class, and I'm sure many of you have gained from it. And Dinesh Khara, thank you for that intervention. Once again, thanks for your time with us today.
What a wonderful debate. This has been a wonderful, constructive exchange of ideas, one that we have come to expect from business today. Thank you all very much once again, Mr. Sabnavis, Mr. Saggar and Ms. Arora. And thank you, Siddharth, once again for a fabulous discussion. Ladies and gentlemen, we can do a little bit better with the applause. Thank you all very much indeed. And I think most of our sessions today have spoken about the